T here. What you're about to see is the kind of price action that separates those who understand markets from those who react to headlines. Gold just got absolutely smashed, down from $2,789 to $2,710 in less than 48 hours. That's a 3.2% wipeout. Billions in leveraged long positions liquidated. Mainstream media calling it a gold correction. Perma-bears screaming the top is in. But here's what they're not telling you. While paper gold collapsed, COMEX registered vaults drained 847,000 troy ounces in 72 hours. Physical premiums in Shanghai spiked to $28 over spot. And the divergence between what's happening in the futures market versus what's happening in the physical market just hit levels I haven't seen since March 2023. So let's cut through the noise and get to the hard data. Because this move, it's telling us something critical about what comes next. Let's get to the hard data. No speculation, just numbers. Gold spot price, as of market close Friday, $2,710 per troy ounce, down from the February 4th high of $2,789. That's $79 per ounce, 3.2% in under 48 hours. COMEX registered gold inventory, drained 847,000 troy ounces from February 3rd through February 6th. We went from 8.94 million ounces registered to 8.09 million ounces. That's the fastest three-day outflow since November 2024. Physical premiums, Shanghai Gold Exchange premiums jumped from $14 over London spot to $28 over spot as of this morning. That's a doubling in premium while the paper price is collapsing. Let me repeat that. Physical demand is surging while paper prices are dumping. Open interest on COMEX gold futures dropped by 31,400 contracts Thursday alone. That's roughly 3.14 million ounces of paper exposure evaporating in one session. Classic long liquidation. GLD ETF outflows. 1.2 billion left GLD over the past 4 trading days. But, and this is key, physical-backed funds like FYS saw net inflows of 87 million in the same window. The pattern is screaming at you. Paper weakness, physical strength. This is the two-tier market in full effect. Now connect the dots. Because gold didn't collapse in a vacuum. The US dollar index, DXY, rallied hard from 106.2 on Monday to 107.8 by Thursday close. That's a rip higher. Gold is still primarily priced in dollars, so when DXY spikes, gold gets mechanically pressured. But notice DXY hit resistance right at 107.8, exactly where it failed in January. As of this morning, it's pulling back to 107.3. That resistance is holding. If DXY rolls over here, that's rocket fuel for gold. The 10-year Treasury yield spiked from 4.38% to 4.51% in 3 days. That's 13 basis points. Higher real yields make non-yielding assets like gold less attractive in the short term. But here's the tell. We hit 4.51% Thursday morning and immediately reversed. Closed Friday at 4.47%. The bond market is rejecting higher yields. Why? Because the data is softening. NFP missed expectations Friday. Expected 156K, came in at 143K. Unemployment ticked up to 4.1%. The bond market knows the Fed's hiking cycle is done. If yields roll from here, gold catches a bid. Bitcoin dumped from $103,700 Monday to a low of $96,400 Thursday. That's a 7% haircut. Why does this matter? Because Bitcoin and gold have been moving in tandem as alternative stores of value for the past 9 months. Correlation has been around 0.68. When Bitcoin sold off, it dragged risk-off flows out of gold temporarily, but Bitcoin has since bounced back to $99,200. If BTC reclaims 102K, expect gold to follow. Equity markets S&P 500 hit all-time highs Tuesday at 6,147, then sold off to 6,092 by Friday close. That's classic risk-off rotation. Money came out of stocks, out of gold, and into short-term treasuries and the dollar. But this is temporary. The moment the dollar rolls and yields drop, that capital reallocates, and gold is the primary beneficiary in a risk-off currency debasement macro environment. Here's the synthesis. Gold got hit by a technical dollar squeeze and yield spike, not by a fundamental breakdown. The macro thesis, debt spirals, currency instability, central bank buying, hasn't changed one bit. This is noise, not signal. Here's your fork in the road. Two scenarios, specific levels, no ambiguity. Scenario 1. The bull resumption gold holds support at 2,695.2705. That's your critical zone. We've tagged $2,610 and bounced twice already. If we hold above 2705 and DXY breaks below 107.0, here's the path. First target, $2,760. That's the 50% retracement of the sell-off and prior resistance from January 28th. Second target, $2,820. This is the breakout level that confirms new all-time highs are in play. Ultimate target, $2,910, $2,950 by end of Q1 2025. What confirms this scenario? DXY breaks and closes below 107.0, 10-year yield drops below 4.35%. COMEX registered inventory continues draining. Watch for sub 8 million ounces. Bitcoin reclaims $102,000 and holds. If these four conditions align, gold is going higher. Period. Scenario 2. The deeper correction. Gold breaks and closes below 2,695 on a daily basis. If that happens, we're looking at a retest of deeper support. First support, $2,650. This was the breakout point from January 14th. It's a logical retrace. Second support, $2,190, $2,610. This is the December consolidation zone and the 200-day moving average. Worst case, $2,520. That's the October breakout level and a full retracement of the Q4 2024 rally. What confirms this scenario? DXY breaks above 108.5 and holds 10-year yield surges back above 4.60%. Bitcoin breaks below $95,000 COMEX registered inventory, stops draining or reverses. Here's the key. Even if we get scenario 2, the macro thesis doesn't break. Central banks are still buying 1,000 plus tons per year. Debt to GDP is still exploding. Fiscal dominance is still the regime. A correction to 2,590 is a gift for physical stackers. It doesn't invalidate the bull market, it resets the trade. So what do you watch in the next 24 to 72 hours? Here's your action plan. Specific, granular. 1. Watch the $2,705 level like a hawk. This is your line in the sand. If gold closes above 2,705 on the daily chart for 2 consecutive sessions, the sell-off is over. If we break below and close under it, we're heading to $2,650. Simple as that. 2. Track DXY at 107.0 and 107.8. If DXY breaks below 107.0, that's your green light for gold longs. If it breaks above 107.8, we're in for more pain. Right now, it's hovering at 107.3, right in the middle. This is the swing factor. 3. Monitor COMEX registered inventory daily. Go to the CME website. Check the gold stocks report every morning. If registered inventory continues to drain, especially below 8 million ounces, that's a massive bullish signal. It means the physical market is tightening while paper sells off. That divergence can't last. When it snaps violently to the upside. 4. Watch the 10-year yield at 4.35% and 4.51%. If yields break below 4.35%, gold catches a bid. If they break back above 4.51%, we're in correction mode. As of now, we're at 4.47%, rolling over from resistance. This is bullish if it continues. 5. Keep an eye on Bitcoin at $102,000. If BTC reclaims and holds 102K, it drags gold higher. If BTC dumps below 95K, gold likely follows. The correlation is real. Use it. Bonus, watch physical premiums in Asia. If Shanghai premiums stay elevated above $20–$25 over spot, while paper prices are weak, that's telling you where the real demand is. The paper market can manipulate price in the short term, but it can't manipulate physical flows. Follow the metal, not the contracts. Zoom out for a second. Let's talk about what this really means. Gold is in a structural bull market. We've been in one since 2018, and it accelerated in 2024. Central banks bought 1,037 tons in 2024, second highest year on record. The BRICS nations are actively diversifying out of dollars and into gold. U.S. national debt just crossed $36.2 trillion. Debt service costs are now over $1 trillion per year. The Fed is trapped. They can't raise rates without breaking the bond market. They can't cut rates without stoking inflation. This is fiscal dominance. This is currency debasement. This is exactly the environment where gold thrives. So when you see a 3.2% pullback in 48 hours, don't panic. Don't sell your physical. Don't capitulate. Understand what's happening. This is a technical washout driven by a short-term dollar spike and rate move. It's not a fundamental breakdown. If you're a physical stacker, you should be thinking about whether this dip is a buying opportunity. If you're a trader, you should be waiting for confirmation at $27.05 or $2,695 before making a move. But either way, the macro thesis has not changed. Now here's what I need from you. If you've watched this far, if you're tracking the data like I am, if you understand that the COMEX game is separating from the physical reality, drop currency T in the comments. Let me know you're seeing what I'm seeing. Let me know you're awake to what's happening. And if you haven't subscribed yet, do it now. Because when these moves happen, when gold rips $100 in a week or dumps $80 in 2 days, you need to know what's driving it. You need the data, you need the intermarket connections, you need the plan. That's what this channel is for. Hit the bell, turn on notifications, because the next few weeks are going to be critical. This is the kind of market where emotional traders get destroyed and disciplined traders get paid. Don't chase, don't panic. Watch the levels, watch the flows, watch the data. Gold didn't break, the bull market didn't end. This is a shakeout, and if you understand that, you're already ahead of 95% of the people watching price. Stay sharp, trust the data. This is T for currency, T out.